Let's talk about a company that has been catching a massive wave of attention in the defense tech space, Ondas Inc. Since today is Sunday, May 24th, 2026, the stock market is currently closed, meaning there is no active intraday trading moving the needles right now. The stock wrapped up its last active trading session on Friday, May 22nd, 2026, finishing the day at exactly $9.06 per share. This marked a minor, flat alignment right at its previous closing base, though the broader context shows the stock has been navigating some volatile waters, sliding roughly 13% over the past week. For anyone managing an individual brokerage account, looking for investment help on top-tier investing sites, or utilizing advanced self-investing toolsets, keeping tabs on these deep price mechanics is essential to understanding where the broader momentum is heading. While the headline numbers show a stock that is taking a breather after an absolute monster run over the past year, the real insight here lies in how the business itself is completely changing its underlying DNA. Most regular retail investors tracking this on popular platforms like the Robinhood app or checking out Fidelity Investments options assume this is just a volatile small-cap hardware play that builds industrial wireless networks and drones. The reality is that the management team is executing a massive corporate roll-up strategy designed to pivot the entire business into a high-margin, software-centric defense platform. Just days ago, the company finalized a massive $196.6 million all-stock acquisition of an Israeli defense firm called Omnisys, bringing an advanced artificial intelligence battlefield orchestration system into their ecosystem. This completely shifts their financial trajectory, yet the stock dropped on the news. This creates a fascinating divergence, where the company's backlog and revenue targets are exploding upward, while the short-term market reaction is pulling back due to share dilution. It is the classic setup where retail expectations are clashing directly with institutional reality. When you look at the general market consensus around Tesla stock, Apple stock, or Nvidia stock, the narrative is usually driven by predictable consumer trends or massive cloud spending computing cycles. But when you look at a name like Ondas Inc., the retail narrative has historically been focused on their automated drone systems and their proprietary wide-area private wireless technology used by major railroads. The general crowd thinks of them as a capital-intensive manufacturing business that has to build, ship, and maintain physical hardware. The contrarian take, and what the smart money is starting to underwrite, is that the physical drones and radios are merely the entry point. The real value is the software layer that sits on top of those assets. By acquiring specialized firms, they are building a comprehensive automated network that handles everything from counter-drone detection to real-time military decision-making. If you are someone who evaluates equities using the Interactive Brokers platform, or if you prefer a managed approach like Schwab Intelligent Portfolios or a SoFi robo-advisor, you have to look past the hardware costs and focus on the high-margin recurring software revenue that is quietly being stacked into their pipeline. Let's break down the recent market action because the numbers coming out of their first quarter earnings report for 2026 are wild. The company reported quarterly revenue of $50.1 million, which is an astronomical increase of over 10 times compared to the same period last year. Think about that level of top-line scaling. On top of that, their product-level operations actually turned adjusted EBITDA positive, hitting that milestone a full 6 months ahead of what management had previously targeted. Because of this massive surge in order activity and the integration of their recent corporate additions, they officially bumped their full-year 2026 revenue guidance to at least $390 million. To give you some perspective, the broader Wall Street consensus was sitting around $379 million. Yet, despite raising guidance and showing a pro forma defense backlog that has expanded to a staggering $457 million, the stock has faced downward pressure over the last few trading sessions. The main culprit behind this downward pressure is shareholder dilution, which is a major factor that any investor tracking equities on the Robinhood trading platform or SoFi Active Investing needs to watch closely. Because the company is using an all-stock model to fund these massive acquisitions, the total share count has expanded rapidly, jumping significantly over the past year. When the Omnisys deal closed, the company immediately issued over 2.7 million shares to the sellers, with millions more scheduled to hit the market in structured installments over the coming weeks. Even though these newly issued shares are tied to strict trading volume restrictions, preventing the sellers from dumping everything at once, the mere presence of a registration filing allowing for the resale of over 3 million shares creates a supply overhang. Short sellers have noticed this, and the stock remains one of the more heavily shorted names in its specific corner of the market, setting up a constant tug-of-war between aggressive shorts and bulls looking for a massive short squeeze. Beyond the technical supply of shares, institutional investors are closely analyzing the company's customer concentration and cash burn. In previous financial disclosures, a massive chunk of their total revenue was tied to just a couple of primary customers, creating an inherent risk profile that makes conservative wealth management desks cautious.
When operating expenses remain high due to aggressive expansion, a business has to constantly balance its cash usage against its growth rate. This is why the stock experiences such massive daily swings and heavy trading volumes whenever a new contract or acquisition is announced. Traders utilizing the interactive brokers trading tools are constantly watching the bid-ask spreads and options order flow to see if institutional capital is accumulating shares on these pullbacks, or if the market is demanding a larger discount to absorb the ongoing share dilution. Comment below how many shares of Ondas Inc. you currently hold, or if you prefer sticking to larger defense names instead. To fully understand why this business model is turning heads, we have to look at what they actually do beneath the surface. Operating through two core divisions, their network segment provides secure, private, software-defined radio platforms that enable mission-critical communications for industrial sectors like major railroads, electric utilities, and oil and gas operations. The second division, which is driving the massive valuation premium, is their autonomous systems segment. This is where they develop fully automated drone platforms like the Optimus system, alongside cutting-edge counter-drone security platforms. Their technology can detect, track, and intercept small, hostile drones entirely through automated cyber and radio frequency mitigation tools. By layering the newly acquired AI software into this mix, they can now offer automated defense networks where the sensors detect a threat, the software optimizes the tactical response, and the autonomous drones execute the mission without requiring a massive team of human operators on the ground. This structural evolution is exactly why the company decided to officially drop the word holdings from its corporate name earlier this year, transforming from Ondas Holdings Inc. to simply Ondas Inc. It was a clear signal to the market that they are no longer just a passive collection of separate businesses, but an integrated operating entity. For retail investors looking for investment help through Fidelity mutual funds or managing their own individual brokerage accounts on the SoFi trading platform, tracking this transition from an industrial hardware provider to an integrated AI defense contractor is the key to evaluating the stock's long-term viability. The historical financials show a business that spent years burning capital to perfect its drone and radio hardware, but the modern financial metrics reflect a company that is finally unlocking massive commercial scale through global defense spending. Looking ahead, the future outlook for the stock comes down to a few critical catalysts and risks that will dictate whether reality can ultimately live up to the massive expectations built into the valuation. The biggest immediate opportunity is the massive global demand for autonomous defense and counter-drone systems. With global defense budgets expanding rapidly, their massive backlog could easily translate into realized high-margin revenue faster than the market currently anticipates. If management can successfully integrate these various software platforms without experiencing operational friction, their margins will expand dramatically, causing the stock to trade more like an elite software enterprise rather than a traditional manufacturing firm. On the flip side, the risks are very real and cannot be ignored by anyone practicing self-investing. The company must prove that it can reduce its reliance on a tiny pool of core customers and successfully expand its sales footprint across a broader array of international defense agencies and domestic industrial clients. There is also the constant threat of further execution risk. Rolling up multiple international companies requires seamless technical coordination, and any delays in merging these advanced software layers could cause them to miss their aggressive margin targets. Furthermore, if the cash burn from integration forces management to issue even more shares down the line, the ongoing dilution could continue to cap the stock's upside potential, regardless of how fast the top-line revenue is growing. When you look across the landscape of online investing, whether you are picking individual stocks on the Robinhood app, building a balanced retirement portfolio with Fidelity ETFs and Fidelity IRAs, or analyzing complex derivatives via the interactive brokers platform, the ultimate lesson here is that market prices are driven by the constant friction between near-term technicals and long-term fundamentals. The near-term technical reality for Ondas Inc. is shaped by short sellers, share dilution, and the typical digestion period that happens after a massive corporate acquisition. The long-term fundamental expectation, however, is backed by an explosive revenue growth rate, a massive multi-hundred-million-dollar backlog, and a deliberate pivot toward highly profitable military software. In summary, the central contrast here is clear. The surface-level market narrative sees a volatile small-cap stock that has pulled back significantly over the past week due to the dilution of an all-stock corporate transaction. But the deeper institutional reality reveals a business that just added a major AI orchestration platform to its toolkit while raising its full-year revenue guidance well past what Wall Street was expecting. Navigating this gap between short-term technical noise and structural business growth is exactly what separates emotional retail trading from professional investing. As the business continues to execute its defense platform strategy, keeping an eye on their upcoming quarterly cash flow reports and backlog conversion rates will tell you everything you need to know about whether this company can permanently solidify its position in the modern defense ecosystem. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.